Hi, I'm Dan Neiman, Co-Portfolio Manager of the Neiman Large Cap Value Fund, and I'm here to tell you a little bit about how covered call options work, and specifically how one simple example of a call option can work for your portfolio. A covered call helps you reduce risk and also provides a cash return on your account on top of any quarterly dividend you might receive. First, I need to explain what a call option is. There are two sides to an option contract. The first, there's a buyer, someone out there who's willing to pay a premium for the right to buy stock. They're going to buy that stock on a specified day at a specified price. The price is known as the strike price, and the date is known as option expiration date. The options are always expiring on the third Friday of the month of the contract. The buyer is speculative, though. They're willing to pay this premium, and if the stock goes up, then they're going to exercise their option. If the stock goes down, then they lose their premium that they paid. So what is a covered call? In a covered call, you buy the stock first and sell the call option to someone else and collect a premium for it. You're basically getting paid to wait. So let's look at an example. In my example, I'm not taking into account any sort of commissions or fees associated with doing these trades. In my example, I have Nike stock bought in March for $77 a share. I'm going to sell the July 80 call to someone out there in the market for $2.50 a share. I'm going to reduce my break even on the stock to $74.50. In that time, I'm also going to collect a 31-cent dividend because my ex-dividend date is June 3rd. So let's look at the scenario. Like I said, I'm getting paid to wait. So I'm going to wait until July, the third Friday of July. And if Nike stock is over 80, I'm going to sell it at 80. It could be at 85, but I'm going to have to sell it at 80 because I went into this contract with someone. I'm going to make $3 from the stock. I'm going to make $2.50 from the option premium, and I'm going to make 31 cents from the dividend. In total, that's $5.81, and you divide that by my cost per share of $77, and I'm making 7.5% over 4 months. You annualize this at 22% if you could do this 3 more times throughout the year. Now you say, what if my stock is above break even but below $80 a share? I'm not going to sell my stock. I'm going to keep it. I'm also going to keep the option premium of $2.50 and my 31-cent dividend over that time period. And my return is going to be about 3.5% over that time period, a lot better than just collecting the dividend. In scenario number 3, the stock drops below my break even. Let's say it's at $70 a share. I have a paper loss of $4.50 a share, but if I would have just bought the stock at $77, I'd have a loss of $7 per share. So you can see the covered call strategy helps you reduce risk. It brings in some cash into your account that you could use to either buy more stock, and in these scenarios, number 2 or number 3, you could sell more options. And so a covered call, like I said, reduces risk. It's more conservative than just buying and holding stock. And if you'd like to know more about how we do that in the Neiman Large Cap Value Fund, go ahead and click on the next series in our videos. You can buy the Neiman Large Cap Value Fund either at Vanguard, Fidelity, or Schwab, or click on the Literature tab on our homepage and invest direct.